How markets drift before they fall. Nothing snapped. Nothing broke. The market didn't fall, it wandered, and in that wandering, danger grew quietly enough to feel like calm. To understand why this matters today, we have to let go of the idea that markets collapse suddenly. Most declines don't begin with fear. They begin with drift, a slow loss of direction where prices still move, but purpose quietly fades. From the outside, it looks like stability. From the inside, it feels like hesitation. Markets drift when conviction weakens but doesn't disappear. Participants are still present. Capital is still deployed. Trades still happen. Yet every action feels lighter than before, as if no one wants to lean too hard in any direction. The system keeps moving, but without intent. The first reveal begins with behavior that feels reasonable. Buyers still step in, but selectively. Sellers still test levels, but cautiously. Moves extend, then stall. Nothing accelerates. Nothing resolves. The market spends more time waiting than deciding. The second reveal appears in participation. Volume doesn't vanish, but fragments. Trades break into smaller pieces. Time horizons shorten. Capital becomes mobile rather than anchored. No one wants to be stuck defending a position if conditions change unexpectedly. Flexibility replaces commitment. The third reveal emerges when familiar signals stop working. Support levels hold, then fail softly. Recoveries arrive, but they feel mechanical rather than confident. Momentum strategies struggle, not because direction is wrong, but because follow-through never fully arrives. The market is moving, but it isn't agreeing with itself. This is the most dangerous phase of any cycle, because drift feels safe. There's no urgency, no fear, no reason to act decisively. Every day without consequence reinforces the belief that waiting is the smartest move. And waiting, when shared broadly, changes the structure of the market itself. Drift doesn't announce a fall. It prepares one. By the time direction returns, the foundation beneath it is already lighter than it looks. Support exists, but it's thin. Liquidity is present, but it's cautious. Conviction hasn't left, but it's no longer doing the heavy lifting. The market hasn't fallen yet, but it has stopped standing firmly. And what comes next will depend on how much weight that drifting structure can still carry. As drift settled in, the market began sending mixed signals that were easy to misread. Prices didn't trend sharply, but they didn't mean revert cleanly either. Each move felt incomplete, as if the market was testing directions without committing to any of them. That ambiguity became the defining feature of the period. The conflict emerged in how participants responded to uncertainty. Instead of resolving it, they adapted around it. Traders shortened holding periods. Investors reduced position size without changing exposure headlines. Capital stayed engaged, but it stayed light. The market wasn't being abandoned. It was being treated carefully. Liquidity reflected this change immediately. Depth was visible, but it felt temporary. Bids appeared, then vanished. Offers refreshed cautiously. The market could still absorb pressure, but only in small doses. Larger imbalances lingered, waiting for someone to care enough to resolve them. The tension deepened as drift normalized. Each uneventful session reinforced a belief that nothing urgent was required. Volatility remained contained. Headlines stayed calm. Models continued to project stability. Yet beneath that calm, the market was losing its ability to respond decisively. Execution desks noticed the difference first. Trades required more patience. Slippage increased at moments that used to feel automatic. Timing became unpredictable. The system still worked, but only if everyone stayed cautious at the same time. Derivatives markets captured the discomfort more clearly. Protection stayed bid even during quiet periods. Skew refused to relax. Traders weren't hedging fear. They were hedging indecision. The risk wasn't direction. It was whether participation would appear when needed. The buildup accelerated as correlations tightened. Assets that normally absorb each other's pressure began moving together. Diversification weakened quietly. When markets drift, relationships change before prices do. The system grows more fragile, without looking stressed. Veteran participants recognize the warning signs immediately. Drift isn't balance. It's unresolved tension. And unresolved tension doesn't disappear, it accumulates. Each delayed decision adds weight to the next one. The market was still standing, but it was standing on patience instead of conviction. And patience, when tested repeatedly, eventually runs out. The next phase would begin with panic. It would begin with exhaustion, the moment when the market could no longer afford to keep drifting and would be forced to choose a direction it hadn't prepared for. Exhaustion revealed itself not through fear, but through behavior. The market began reacting more to small disturbances than it should have. A minor data mislingered longer. A routine comment moved prices further, not because the information was shocking, but because the system no longer had the energy to absorb it. The conflict intensified as drift collided with pressure. Moves that once resolved quietly now dragged on. Buyers hesitated. Sellers tested further. Each extension felt slightly disproportionate. The market wasn't panicking. It was tiring. Liquidity exposed a strain clearly. Depth appeared uneven. Some levels held briefly. Others failed without resistance. Capital stepped in late, after moves had already traveled. Support was reactive instead of preventative. The market had lost its ability to lean against uncertainty. The buildup accelerated when correlations tightened sharply. Assets that usually offset one another moved together, amplifying pressure. Diversification thinned. Strategies designed for smooth transition struggled in an environment defined by hesitation. Drift had quietly weakened the system's internal shock absorbers. Institutional systems reacted mechanically. Algorithms reduced aggressiveness. Risk controls trimmed exposure, not because limits were breached, but because signals conflicted. Each adjustment removed more energy from the market, reinforcing exhaustion. Veteran participants recognized the danger immediately. Markets don't need panic to fall. They need fatigue. When participation becomes conditional and conviction fades, even modest pressure can push prices further than expected. As sessions passed, exhaustion became visible in recovery attempts. Bounces were shorter. Volume faded quickly. Each attempt to regain balance felt forced. The market still functioned, but it no longer felt resilient. The tension peaked when a familiar support area failed without a fight, not because sellers overwhelmed it, but because buyers never arrived in size. Drift had trained participants to wait, and waiting had become a liability. That moment clarified everything. The market hadn't fallen suddenly. It had been drifting into weakness for weeks. And now, exhaustion had removed the last buffer. The final phase would show how quickly drift turns into direction once the system can no longer delay decisions, and why the eventual move feels so surprising to those who mistook calm for strength. Direction arrived without drama, but with finality. Once the market could no longer drift, it began moving with a clarity that felt sudden only because it had been delayed for so long. Prices didn't collapse, they accepted lower ground. And that acceptance spread quickly. That was the climax. Not a panic, but a release. The tension that had been building during weeks of hesitation finally resolved. Participants who had waited for certainty found it, but at levels they didn't expect. Liquidity returned only after direction was obvious. Capital that had hovered on the sidelines stepped in cautiously, no longer to defend, but to adjust. What shocked most observers was how ordinary it felt. No single headline explained the move. No obvious trigger justified the shift. Yet the outcome made sense to anyone who had watched the drift closely. The market wasn't reacting to new information. It was reacting to accumulated indecision. The resolution unfolded as behavior normalized again, this time around a clearer direction. Volatility stabilized. Participation returned selectively. The market found balance, but it was a lower, firmer balance shaped by acceptance rather than hope. The deeper lesson was unmistakable. Markets don't fall only because of bad news. They fall because waiting exhausts the system. Drift drains resilience quietly. By the time direction arrives, the structure underneath has already weakened. Drift is not stability. It is deferred choice. And deferred choices always arrive with interest. Understanding this changes how calm periods should be interpreted, not as proof of strength, but as a question: is the market deciding or delaying? Is confidence holding it up, or patience holding together? because when a market drifts too long, the fall doesn't feel sudden. It feels inevitable. So what do you think? Are we watching direction form right now, or are we still mistaking drift for safety? How